All right, a very warm welcome to you. This is yet another episode of Market Pulse, where we give you all the latest information that is currently happening in the business world. And of course, this being the season for results, the first bank to announce their results here in the country, of course, is Stanbic. And just looking at those numbers, we're talking about 13.7 billion in profit after tax. This is quite a significant number. And to help me speak on these numbers, I'm here with Joshua Igara. Joshua, thanks so much for making time to be on Market Pulse.
Thank you very much for hosting me.
The last time we sat during these results was mid last year.
Correct.
And it was right at the peak of the demonstrations that were going on in the country. And I just want to know, what kind of effect did that disruption have to the business?
I mean, I'm quite impressed with the results we have announced today, which is 13% up to 13.7 billion, because by half year, we were more or less 4.5% up year on year. Obviously, we had a difficult quarter two, and of the quarter three because of the demonstrations. And that has a significant impact in the way our clients' activities and operations were last year in the market. So if you see like our loan book, as we went to the end of the year, you saw that loan book dropping more significantly by December by 12%. Yeah, we were doing so well by June, correct? Now, I would say that a number of our large clients, whether they're in manufacturing, there was also a second item where interest rates increased actually during that period when we had spoken. But I'm happy to say that as we go into October to December, there's some resumption of normalcy into the market. The difficulties are still there, but obviously there's, in my view, the business activities are seeming to be picking up in a manner despite higher tax regime, despite high interest, which are now coming down in January, February, and sectors were affected the most: manufacturing, real estate, and trade. Those were affected the most. Agriculture did very well, tourism did very well for ourselves, and those are the areas we are looking forward to. So I would say that last year's first half was actually affected because of the difficulties we faced, but I'm seeing optimism in the way our clients are transacting this year.
All right, so let's talk about your revenues. One of the things that we have seen in this result is that revenue is down about 3.8% to about 39.9 billion.
Correct.
And so I just want to know, what are some of the factors that were happening in the industry that led to this?
So our revenue dropped last year by 4%. It was largely for two main reasons. So one, as interest increased much higher. So interest income by itself, gross, increased by 24%, which was a good momentum for growth. But interest expenditure doubled last year because it was a very tight local market environment. Remember, the sovereign was funding itself significantly from the domestic market. Interest rates increased extremely high, aligned with the central bank increase in the central bank rate. So that was one area that we saw a deceleration in our growth momentum. And then number two, we had a very significant transaction in our result in 2023. If you remember, it was a massive capital market transaction. Now, that transaction did not repeat itself this year. So if you compare in terms of other fees, that fees were not, it was a very significant amount. So if I remove that from the conversation, our income will be up by between 4 to 5% year on year. And then lastly, our loan growth was affected because we now did not grow as fast as we wanted by the end of 2024. All
right, and actually it's a good thing that you lead us into that conversation around the loan disbursement, because we're talking about loans going down by about 12%. This is to 230.2 billion.
Correct.
And also just looking at deposits, which also slowed down by about a percentage or so. And I just want to know, what does that then mean in terms of when you look at the macro environment that we're in and you see deposits going down? What does that mean?
So I would say for us, the biggest concern largely was that last year in the second half, a lot of the biggest competitor with our deposit and liabilities was largely the government. They are offered extremely highly attractive rates last year for many reasons. And I think that when you talk about crowding out the private sector, at the end of the day, government has to find ways to increase revenues and let industries deploy its capital into productive sectors of the economy. So that's one issue we saw. And you see some actions this year. Last year was a very difficult one for funding. Most of our cost of funds increased, clients with their deposits. So when we remained roughly the same as last year, I would say it's a very, very strong outcome. And that's one item. The second item for us was around what happened with the lending. So out of our 12% minus growth in our loan book, the biggest challenge there was the strengthening of our currency. year on year in the month of February and March. So that contributed an 8% reduction. Actually, if you look at foreign currency loans, they contracted by 14% in the industry. And that's a good correction, which we saw. So we expect us to grow this year because we don't expect that kind of impact before. Local currency loans, overall, were growing at 4%. And for me, that's an issue we need to build on. So I am excited about the local currency growth in terms of our credit. But of course, high interest rates last year had a massive knock-on effect in our ability for customers to take new facilities. What did we see? We saw no repayments. We saw high repayments. Customers came and said, remember interest rates went as high as 24%. And they're coming from 16%. So that huge increase, clients find it more difficult to be able to take on new facilities. And that is the biggest challenge you saw for us, including our large customers. So that's what you saw last year. And I've always said for me that high rates are not beneficial for the industry. And from our point of view, you saw that higher rates, what they meant is our lower growth on our loan book.
All right, so you're talking about, and this is during the Q&A session that we just had earlier on, you're talking about growing the loan book by about 8 to 10%.
Correct.
And the question is, in terms of nominal terms, what are you looking to issue to the market?
So for us, remember our loan book today at 230 billion. Correct? So at 10% of that is 23 billion. Naturally, we grow our loan book in a year between 40 and 50 billion, naturally. And that's not very difficult to achieve in our business. So the quantum, it's very possible for us to go beyond 10% year-on-year growth because it will be just more than 23 billion. Where do we see that growth coming from? That's a big question you may ask. As interest rates come down, so we are seeing a lot of trade activities that are picking up this year. We expect that to be a single largest growth driver in our business. We see a lot of work going on into some of our agricultural businesses. Agriculture is coming up. We've been blessed with good weather in our market that we're running. We are seeing export-oriented companies that are doing regional and global exports, being able to do a lot of activities. We are not very certain that growth in real estate and housing, which is a big segment for us, and manufacturing, those haven't been as faster growth engines for this year. But I'm very positive that as you settle, one of the things we've been concerned about, pending bills, have struggled a lot of our clients' activities. And as innovative ways are found to resolve them, we believe that credit growth in those two segments will be able to come in on board. But those are our lowest ones. All
right, so of course we can talk about the credit market without talking about risk-based pricing.
Correct.
And the big conversation that we have seen at the beginning of this year, and especially after the Monetary Policy Committee meeting, is the push by the central bank to have banks now implement risk-based pricing. And the question that a lot of Kenyans have, number one, is did it need to take the regulator for banks to start implementing that? And number two, what is going to be the net effect of that to different banks and to the sector in general?
So let me answer this question in a way that makes it easier just to explain from my perspective. Your question is right. Because we already have a model that has been approved, the risk-based pricing model, naturally you don't need anyone else to tell you how to adjust the price. It's a very market observable benchmark that we have. So if you look at our example, we started our lending rate before this last year. We saw our base rate increasing all the way to 17%. Correct? It's now down to 15.5% from 19th of March. So client will see better prices already as we speak from this month. That we announced it a month ago. And we've seen industries move. And it's because the cost of funds have actually adjusted. And that has given us the ability to be able to reprice our loans. Now, why was it not happening last year? This is the biggest question I want to ask. Our risk-based pricing is not very sensitive to the changes in the cost of funding in a particular month. Normally, we have what you call as an averaging model that applies 12 months of cost of funding. So remember, if you take 1 month change and then you're trying to average it for a year, the consequences are not very high. And for me, this is the biggest question I will say to you, that perhaps it's time for us to sit back and say, does the risk-based pricing model as we have today address the market concerns and client concerns as it is set up? Maybe it's time to actually revisit the models. And this is the conversation we're having as Stanbic with our regulator.
Because one of the things that you said is we believe we need a model rate. And of course, I want to know, from where you sit, what would that rate look like?
So, it's early days to say how it will end up. But if I give you the benchmark, we don't always have a problem when it comes to foreign currency lending.
Yeah.
Because we have a reference rate, which is your SOFR rate today that we're using as a basis. A number of markets in the continent have matured to have a reference rate in local currency. So can you imagine if you have like a Kenya shilling reference rate, which then determines, it's very easy to see, customers can understand that kind of rate. I believe that's a model we should be seeing. Are we ready as a market? I think we are. Remember, we've run risk-based pricing for more than 2.5 years.
Yeah.
So maybe this is the time to have that conversations. I'm not sure whether we can achieve it in one cycle, but a number of markets in the southern of Africa and in the western Africa have actually been able to mature in that kind of model.
All right, so Joshua, there's a number of things that are currently happening within the Kenyan market, and one of them is the fact that rates have come down. We see inflation remaining well anchored.
Correct.
We see different sectors of the economy sort of bouncing back.
Correct.
But the question that a lot of people cannot explain is the stability of the Kenyan currency. It has remained well anchored since for the first quarter of last year. A significant drop from 161 to about 129, and it has remained around that. The question that a lot of people would want to know is this going to hold?
We've done a lot of reforms. If you remember early last year, trying to build a very strong interbank market, which is what had actually collapsed as an industry. If you remember, and I salute a lot of work done by a governor, Governor of Central Bank, Dr. Kamau Thuge, and his team and the industry. So if you look at the broadening of activity in the interbank, that has been very tremendously done by a lot of changes and just modification of how the market functions. Number two, you've seen the central bank being in the market and being able to increase the level of overall reserves at the national level. They are all-time high since 2021. And obviously with inflations being well anchored and the interest rate coming down to where they are, I would say that the fundamentals of our economy today, from a macro perspective, are actually quite well anchored.
All right, so let's zero back to Stanbic. Now, last year during our conversation, one of the things that you were saying you were targeting to be able to grow your loan book and increase your customer base was the retail customers.
Correct.
And I just want to know, what is the progress on that, and how has that translated to the results that we have seen?
Very exciting part. If there's one area I'm very excited about, last year our customer numbers increased by closer to 30,000. We had a few more centers of representation of branches opened up actually last year. We also launched our private banking new solution in the market last year in October, which has been very exciting. Launched a new card in partnership with the MasterCard. And if I look at the activity, that business that did extremely well last year. In fact, I bet that our growth this year for that business will be between 25 and 30%. So we're seeing more clients coming in. We're seeing, and most of them are on the private banking space, and we're seeing most of them in the consumer segment space. One of the things we also are doing more is using a digital tool. Now we now have a cash advance model with our own scorecard. That scorecard is giving customers new facilities, new loans on a short-term basis. Now, today we are less than 10, 20,000 clients in that model. But you can imagine if we are able to put all our 250,000 clients scored in that model, the chance for growth for our business is exciting. And I just love the feedback we see. We also improved our mobile banking platform last year. We invested in a new mobile banking. We upgraded our core banking system. So all the rails have converged in terms of supporting our clients. And we will see more centers being opened this year in 2025. And therefore, I am very hopeful that when you look at our results, last year was an investment year for our consumer banking. This year we see them growing at 20-25%.
All right, so let's talk about the investments that the bank is looking at in 2025. Could you tell us how much your investment outlook is and in what areas?
So in a year, generally we are investing between 3 to 4 billion shillings overall, and some of them largely are in technology and infrastructure. Those are the two biggest areas we're doing to renew the facilities, to bring in new core banking, which we did last year. We're now putting in a new platform for our SME and commercial and consumer banking clients. We're enhancing our online banking platform this year as well, training our staff as well in terms of relationship. We're also hiring more people actually this year. We've doubled the number of our relationship managers last year to be able to serve our clients much better. Now, what are we driving towards? Enhancing our level of client experience and customer satisfaction score this year. We measure through something we call a net promoter score. So during the migration last year, we had some complaints that the system was not available. We had achieved this year 99.9% reliability for our solutions.
Yeah.
And we're trying to improve our Net Promoter Score to beyond 50 by third quarter of 2025.
All right, so let's talk about headwinds that you're looking at in 2025, and of course NPLs from an industry perspective is a bit concerning. So for Stanbic Bank, there is a question around what are some of the headwinds that you're projecting in 2025, and how are you planning to sort of get through that?
So we've been very well moderated in terms of our posture for the risk we're taking in our portfolio. I mean, our NPL last year closed just shy of 10%. And industry's ratio was 16.4%. So we're very much lower than where the industry is. What I would say, and high interest rates was a massive attack on the quality of our customers' ability to settle. So that's always it, because as interest increases, then you need more money to pay for the same facility, or you need a longer time to pay for the same facility. So I am very clear that we are watching very carefully, and that's one of the reasons why we adjusted our rates, actually, because of risk-based pricing. Lower rates mean that clients have more flexibility to settle. What we are concerned about ourselves is that there are always obligations for many of our clients, which they have supplied goods and services, and they are still waiting for payment more than a year later. That I don't have a good answer for. Will we resolve that issue this year? I don't think we'll be able to resolve even half of that challenge, and that remains a bigger problem. Remember, our NPLs are largely related to what is outstanding payment to clients. Correct? So we have one solution is lower interest rate. Another solution is we have to pay the pending bills through additional liquidity into the market. So that's a challenge we have asked for the sovereign. Those are the two biggest issues we have. And then finally this year, obviously the very significant pronouncement by the new administration in the United States, the executive orders that you're seeing around international support and development for international organizations, a number of those are our clients. And we believe that whether it's on healthcare, whether it's on employment, on housing, those are areas we believe that early enough will have an impact in the way. So that is a risk we are addressing ourselves. So we will say that maybe the impact may not be as significant as early days. And the way to resolve that issue is hopefully to find some stability from the bigger markets like the US or counterparty countries like Eurozone to be able to address. Or the government takes over some of those obligations that were being met by international partners.
All right, so of the 10% that you're looking to grow your loan book, there's a question around how much of that do you expect, or are you forecasting will account for SMEs and medium-sized enterprises?
I mean, we anticipate more than 1/3 of the 10% to actually be from the SME client portfolio. And what happens in this business segment is a very good question to ask. The loans are always very short term. So it's a working capital facility for 3 months, for 6 months. So traditionally, our loan book will grow by 35 to 40 billion on that segment alone. But it's also repaying itself by close to 25 billion. So you take a facility today, you settle it tomorrow. What we want to do is to increase our activity. So we are targeting to double the size of activity in our client portfolio this year. Even if there is repayment of the 10%, we expect that 3 to 4% of that will be sticky lending in our SME portfolio.
All right, so just in closing, Joshua, there's a question around when you look at the policy environment that we're currently in here in the country, what are some of the areas that you are really worried about going forward?
At macro level, what always concerns us obviously is, so first let me salute that the fundamentals of how you measure our economy, a lot of that has been very anchored. That's a positive side. And Kenyans may say, okay, we're not sure about inflation, but I would say that the numbers are the numbers. We have to track those numbers, and sometimes they work for us when they're high, and they work for us when they're low. That's one issue. The Monetary Policy Committee has pronounced it very, very well about the central bank rate. Growth has been affected. Normally we grow at 5.2, 5.4, 5.5. Now we're growing at 4.6%. Credit was not growing as much as it should last year, and we have explained the reasons why with this. So my view is that if those elements are landed, and then there was high tax regime last year, which brought in a lot of difficulties for most of our clients and businesses last year. And I would say that is in the past. I am very much a believer that the shock has been absorbed, sometimes positively, but most of the time it was negative for last year. So if those 4 measures are done, we should be able to see exports from our group of companies today in our market. We should do more trade, import of goods and services in our markets and transport into the region. much more work on agriculture businesses, which is a big part of our portfolio that we have, energy, oil and gas, a big part of our growth as an organization. And finally, we do believe that the housing work will start bringing in much more lending and mortgages and solutions for affordable housing and medium income housing. Then manufacturing remains a big area. I've seen it struggle last year, but I am always an optimist that we have to fundamentally shift the work for manufacturing to create the jobs, to export our goods, increase export flows, and that for me will be the way I would summarize this year. It's a year of growth. Last year was a year of resilience.
All right, Joshua, I think that's a good place to end. Thank you so much for making time to speak to us here on Market Pulse. And of course, that's how we wrap up this conversation. And you can be sure to keep up with us every Wednesday right here on Market Pulse.